Good afternoon, everyone. It's a pleasure to be here today. The AI economy is no longer speculative. It is rapidly reshaping the core of modern industry. This panel will dive into how AI is breaking down traditional sectoral silos and unlocking new value by enabling real-time intelligence, adaptive workflows, and unprecedented cross-sectoral collaborations. At the heart of this transformation are interoperable platforms, shared infrastructure, and a collaborative ecosystem that supports scalable and sustainable AI integration. We aim to explore the next generation of AI-driven innovation and examine how stakeholders are investing in and enabling this transformation. With me on the panel, we have Khailee Ning, Managing Partner, 500 Global. Pleasure having you here. And we have Shmuel Chafets from Target Global, founder and partner. To set off the, I guess, discussion, I'm curious about your perspectives about the AI landscape today. Where do you see the biggest investment opportunities in AI right now at a very high level?
Well, at a very high level, of course, you can organize it by platform and then, infrastructure, platform, and applications. But what I would say right now that a lot of the biggest opportunities that people are not paying attention to is land grabbing customer acquisition. Like, people believe that like AI is everywhere now, but every month, ChatGPT only has 400 million users. That leaves the rest of the 5.5 billion internet users. 93% of the internet don't log into ChatGPT. So there's still a lot more people that haven't even experienced their first experience with AI yet. So any kind of consumer-centric land grab of all these sectors, like that's what at least one of the big things that I'm focusing on right now.
How about yourself?
Well, first of all, there's a slight risk. There's someone who's here in my last conversation, so I'm going to be consistent, which is a problem for me. But I think that there was a huge wave of investing in like these large language models, etc. And now I think, at least I'm very focused on the data opportunity. I think without proper data gathering, proper data management, high quality data, the AI revolution is not going to get to the next level. I think there's a lot of investment made in sort of the hardware, a lot of investment then made into the models, but now there needs to be, the next iteration of improvement will only come from data and data gathering. That's where it has to be.
You know, Nader, before you add on, it's so good that we have complementary part of a stack we're investing in, but notice that we didn't talk as much about infrastructure. Yeah. One thing like Josiah, I think, has come out to speak about is that there may be an overinvestment in infrastructure, but that's a good thing for folks like Shmuel and myself. Because if there's like so much investment in all this data centers and AI compute, it means to actually make the money back, they're going to try to acquire all of these application developers, and they're going to give compute for cheap. So I think there'll be a big timing where compute is going to be super cheap before it gets more expensive again for developers.
I actually think that's an interesting question. If we make this a little bit more of a discussion, maybe, if moderators.
We just took over his job.
Yeah, exactly. Just classic VC. But I think that we're in a very different environment than we were when, for instance, cloud computing started, right? We're in a very different cost of capital. And I think one of the things that we're constantly thinking about is all these hundreds of billions of dollars who are going into compute, into infrastructure, into training models. Companies are going to have to recoup them, right? It's heavy, even for a Google, Microsoft, that's a lot of money. And they're going to have to recoup them. The only way to and they're going to have to recoup in an environment where if you sort of DCF $100 billion investment now, that's pretty expensive. So I think a lot of these models are going to get very expensive very fast. Very expensive, and a lot of the usages that people are thinking about today for models are going to become marginal at best. If not, we're going to see a wave of people who've gone to AI and are going back to bodies or to machine learning or just sort of going back a generation because the things they're going to do are not going to be economical, and that's one of the reasons that we're like staying away from applications.
So is that why?
Oh, that's great. It's going to be a great discussion, I can tell.
Well, that's what I was going to point out because controversially, your modes where you see the industry going is slightly different. You're talking about scale, Khailee, and Shmuel, you're talking about proprietary data as sort of the moats there. I'm just curious about those differences. Based on the infrastructure play that you're talking about and the scalability, where do you see, based on what Shmuel was saying there, where is it all going in your point of view? If it's getting more expensive, cheaper on an infrastructure layer, and what does that mean on developing that mode on scale?
I think everything he said is actually absolutely true, and everything I'm saying is also true, but at a different timestamp. So I think what happens right now is that all the cloud computing folks are giving free credits to my startups to build on AI, and later on they're going to charge you a lot, right?
Yes.
I think the other, so it get more expensive, it get cheaper, and these things kind of ebb and flow like cloud. It's never going to be as cheap as cloud because it is way more expensive to do it, right? So that point is completely valid. But at the same time, is that the other components. And just to build out the territory of this conversation, there are other components to the cost of actually AI at scale to cover 5.5 billion people using AI applications that a lot of people aren't talking about. It's actually processing voice. Processing voice with APIs like Twilio's API. WhatsApp is charging people a lot of money to use WhatsApp. So for you to actually open up your WhatsApp and talk to your AI, or AI giving you phone calls and all of that, it's currently very cost prohibitive. So for actually the world that I want to see, where a lot of application developers can build utility for everybody else, it's not just the AI compute costs that have to come down, which I hope they will, and I think they will. There's also a lot of other types of costs related to calls. So hopefully the telcos of the world seize this opportunity and say, look, this is a time where I can be like an ally to innovation and monetize by partnering with these startups in a very, very different way. And hopefully the telcos can also be a distribution pipeline and bundle software for the rest of the world. So this, again, another kind of tangent that I'm noodling on, but it looks like Shmuel may have a different view.
No, actually, I think it's a relatively similar view, but I think first of all, the reason that I'm thinking about data is because if you look at how efficiency improves, and in the end, this is all an efficiency game, because the more applications you want to put on these large language models, the more things you want to do with generative AI, the more a lot of it's going to boil down to a cost question, right? Is this cost efficient enough? We saw it, by the way, with the blockchain. People were talking 8 years ago, we were sitting here and talking about blockchain and how it's going to change the world. And in fact, it hasn't changed the world. And if you look at blockchain today, it's boiled down to one coin is 80-90% of the market. I mean, it's a financial asset rather than anything else. And that's because efficiency wasn't reached, right? Blockchain could never get to anything efficient enough to run something significant on it. And that's the risk with AI. I don't think it's going to go there, but I think the risk is for some things just going to get too expensive. So the models have to get better, and we're going to have to get better at using them. So use smaller models, use more targeted models, use more edge computing, things like that.
I'll take the leaf of that. The smaller edge ones, that's the key to making AI much cheaper and more widely adopted. Because right now we're still in this paradigm where we're using very expensive models, like general models that do everything just for you to actually do only one small thing. It doesn't make sense. But at the more of my entrepreneurs that I've backed, that they have taken open source models and actually dumbed it down, and they're running it with very, very little things. They don't have to rely on them. I'll give you a real example. I wanted to create an AI twin for myself, so that I don't need to do any more social media anymore, right? I'll create AI twin. But I didn't want to pay HeyGen, because like I'm cheap when it comes to software, right? So I don't want to pay HeyGen and keep using it, because I want to use it like long term. I don't want to play with it. I want to use it long term. So I asked one of my friends who's did data labeling company for many years. I said, look, can you get some open source models that can be crappier than HeyGen, but let's fine tune it ourselves. Let's make it better. And right now we have it running on a home machine, and it's doing better than what I have in my HeyGen twin. So I think that as more application developers realize that they can actually fine-tune things and make it more narrow and specific for usage, cost of their compute for their use actually goes down.
I think there's going to have to be some natural selection, right? There's going to be natural selection. Some things are going to be worth doing with generative AI. Some things are not. It's again, long-term innovation. Short-term innovation is very hard to overstate. Long-term innovation is very easy to understate. It's a rule of every innovation cycle. I think everybody feels the world's going to change tomorrow. It will not. Everybody's over-investing in AI. It's clear a lot of that's going to go to the garbage. Right now, I think a lot of companies I feel are investing, particularly big ones, the big hyperscale companies, are investing a lot of money in increments, not exponents, actually. So they're going to get incremental development, not. And again, you go back to the data point. I think in order to get models to be more efficient, we've thrown all we can on silicon. We've thrown all we can on the large language models. Now you have to take care of the input question. If the input's not good enough, and speaking to your Twitter clone, Twitter, twin. If its input's not good enough, the output's not going to be good enough. It's going to waste a lot of time and energy and money on fine-tuning it, and it's just going to be less efficient, and you're not going to be able to use it long-term. That, I think, is where this ecosystem is today.
Maybe just picking up of what Shmuel was saying earlier as well, Khailee, I'm just curious about your point of view around, so with blockchain, we've seen sort of the power law play there. Now with this land grab that you were talking about earlier, do you think there's going to be a power law? And then the follow-up question I have to that is, how are you underwriting the risk when you're writing checks when it comes to that as well? I'm curious about the ROI question.
Yeah, well, I'll take the leaf of the blockchain thing and also qualify some of my perspective. Because I actually forget like which stage you typically invest in. But for us, a lot of the platform that 500 has built invests at the earliest seed stages. And only more recently, we've got the growth stages at $5 million to $10 million US checks. But most of our checks, like it's kind of people with ideas and rolling things out and seeing how things grow quickly. Now, why I qualify that is because we've seen that, to your question about blockchain and underwriting risk, is that there are generations of blockchain startups that we've backed that never got the adoption they dream of. But it's not because of technology. It's because of the incentives of adopting it. Blockchain promises transparency, transparent supply chains, transparency in agri-tech. You know, a lot of parts of the world, people don't want transparency, you know, because different people benefit from the lack of transparency. So there's a lot of people in places of power in different industries in different parts of the world. It's like they don't want the transparency to come. So for those startups to succeed very well, it needs a very orchestrated approach, you know. And I think that, so I'll put that aside for blockchain. I'm very bearish on real world assets. I also think that there's a lot of adoption incentives, human incentives against its adoption, and so I'll just put that aside for a moment. So when it comes to risk, right now I'm very, very, very particular about sales cycles. If there is, like I mentioned, if there is more than 5.1 billion internet users who've not used ChatGPT, guess what? Gemini is going to be pushing out through all the Android phones. That's 3.3 billion Android phones. Microsoft's already pushing out across 1.4 billion Microsoft users. So in the next 12 months, there's going to be billions of people who are like, wow, AI is so cool. What else can I do with AI? And a lot of these applications for the rest of the world, I want them to be more like Cursor. I want them to be more like you can just swipe a credit card, you can just start using it, and you can just start paying. And I know Shmuel's going to dive in right in, but I'm going to give you a real example right here in Dubai. We backed a company that does AI video tutoring to learn English. It's called Practica.ai. 12 months revenue, collected revenues, $20 million US. Built out of Ukraine and Croatia, Eastern Europe. They moved here to Dubai for taxes because they only have 4 staff. 2 founders, 2 staff.
Yeah, but I think you're touching one of the problems of the current AI ecosystem, which is the fact that we're seeing a lot of what we call ERR, right? You're seeing a lot of like experimentation happening. You're seeing, because it's so easy, because you swipe a card, because you don't need, because adoption's so easy, I think, and we're seeing it less, we're seeing it in B2B and B2C, but I think more in the sort of B2B world. We're seeing a lot of companies just experiment with a lot of tools, and churn rates are unbelievable. You know, marketing costs are going up. So there was, I think, this honeymoon stage for a lot of these AI companies. You saw companies going from like 0 to 20 million in a month. We're seeing it, I think a lot of it is normalizing, because in the end, it has to normalize. It has to normalize. It'll be more efficient than the last cycle. So I don't think we'll see one person billion-dollar company. Maybe as an anecdote, we'll see 1 or 2. But I think in the end, these businesses will still be significant size, and they'll need personnel. They'll need less. They'll be more efficient than the cloud businesses, who are more efficient than the on-prem, who are more efficient. The efficiency will continue, but you have to also sort of scale yourself to think it's not going to be a 10, 20, 30x growth. It's going to be incrementally better, which is still great, right? It's much incrementally better is still.
Well, I guess better. Like venture capitalists would not want to index or invest in the generalities of all these statements, but pick the exceptions of those things, right? And so, at least from the companies that we're seeing, of course, we look at cohort analysis and retention and churn. Like these are the basics of venture capital. But more importantly, is that the struggle I have is that they don't need so much of my money. So I raised this fund, and then like I can't put as much as I had wanted to into these companies because they become profitable so quickly. And then so I'm trying to innovate a little bit more. Ask them, so what do you actually need? So I think revenue-based financing, folks like General Catalyst and others, getting more into revenue-based financing. I think that there are certain new options, I think, for asset managers to have exposure to these types of companies that need to consider that may be a little bit outside of the typical seed checks.
I don't think they're going to need less money, actually. I think it's changing the moment in time where the money is needed.
Yep.
And I think, again, that's across the last 30 years. We've seen that moment in time move farther and farther away, right? In the beginning, you needed $20 million to start a company because you needed to buy server racks and you need to put like computers and you have IT people. And then you went and you did it in Amazon. Now, so it just pushes the time. But I think the actually later stage, that marketing stage, the cost of compute, all that, I think those companies will need an equivalent amount of money to scale, actually.
Yeah, no, absolutely.
It's pushed farther down the chain. And that's interesting. It's a huge opportunity for for seed venture, right? For seed stage VCs, it's a huge opportunity. It's going to be a bummer for mid-stage generalists.
On that point as well, I'm just curious about the sectoral areas of where you're seeing the most disruption. Is this a one-size-fits-all? And maybe circling back maybe at some point to the RWA bearishness that you alluded to earlier, but just curious about where the opportunity window is and maybe circling back to why the bearishness in the RWAs.
Well, we'll let Shmuel go first on this one.
Yeah.
I think we're going to see it in very different places. I think the place we're seeing the most opportunity is we're seeing companies who are scaled, who are able to really transform their business with AI. So they have data, they have the user base, they have the connectivity, the Rails, the Salesforce, and then they can take AI and just make their business so much more efficient. I mean, our example always is TravelPerk, one of our portfolio companies. It's a business travel company in Barcelona, and they've completely transformed their business. They've doubled their margins. They've done amazing things using AI early and building in-house tools. We have a team, and we're seeing it across our portfolio in a few places. I mean, Klarna, not our portfolio company, but another sort of interesting example. We're seeing companies who are doing that well, and I think it's making them more competitive. It's changing the unit economics. It's completely transforming unit economics of these sort of scaled but not yet mature companies. That's where we're seeing a huge opportunity right now.
I'll take Shmuel's point over there about late stage, because for us, we have a practice within the firm to build SPVs to create access for our LPs to participate in some of the winners. Now, we had created a lot of participation for Canva, but we also sold down some Canva. And sometimes we say, oh, did we do the right thing and the wrong thing? Because we were there in the seed check, so the seed check makes money, right? But again, these later stages of Canva. But to your point is that Canva completely transformed their revenue with AI. It's like, it's so easy. You don't have to like do things in Canva just to create what you want. You know, you can literally like speak things into existence with Canva. It's amazing. So Canva's the perfect partner to actually roll all these things out. So I think there is a world, to Shmuel's point, of like later stage scaled companies. They're category leaders. They've got moats, and they can roll out AI, and these startups have no chance against them. No chance, because they need too much money to actually acquire. So I think those are some of the risks and things that we have to consider if we're looking at seed companies to so-called disrupt the old guard. That's actually probably a risk point. I kind of forget what your question was, though. The RWA bearishness that you were alluding to earlier. I'm curious about why. I'm curious why you're curious. Like, you guys quite interested in RWA?
Well, to be honest, so my point of view is with every sort of solution that's coming out there, you have to look at what already exists and doesn't actually disrupt, and actually is it more as a business model efficient, driving the change that you're looking for. With RWAs, I have a question about, is it actually really driving that change or not? But I was curious when you said you're bearish, why it's more negative as opposed to status quo or even better.
So currently, I think to contextualize the whole narrative and then to address the RWA thing is, I think what Shmuel and myself, if I understand this right, is that we're talking about adoption curves and price curves. Now, these adoption curves and price curves, they happen in different places, different timestamp. You got to watch these things. Now, for RWA, why the adoption curve has been it's not been picked up is because the early innovators who have acquired a lot of the assets to tokenize, they've acquired these assets that a lot of people have never wanted in the first place. And so you can tokenize whatever junk crap you want, but if people never wanted it, it's a problem. Now, there are experiments like Temasek in Singapore, like they've actually tokenized a lot of the best funds, best ETFs from the biggest Main Street names, and the uptick there has been pretty good. So I would say that for RWA to get on board, for people to really engage with it, the underlying assets have to be worth tokenized, have to be worth trading in the first place.
Well, I also think, I mean, of course, I think it's a very complicated question, because like every financial market is regulatory driven, right? There's a regulator, and the regulator is there for a reason, right? To protect people. And the unregulated part of this market has been very predatory. Yeah. It is very predatory. It is not a good market. There is a regulated part of that market. It's starting to develop. there's work in the US, there's work here, there are interesting things happening. But in order to really have, let's say, DeFi as an asset class or tokenization, it has to be regulated. And then it will lose some of its attractiveness as a market, right? Because the attractiveness for a lot of the participants is the lack of regulation. And it's sort of, you have to break that chain. That's I think, a part of the problem.
Well, there's also a world that sits outside of this that you may not call it RWA, but it's a world that's on the streets, trades are happening. It exists in collectibles, sneakers to trading cards. So a lot of these types of assets that have natural supply and demand, digitization, tokenization helps make those things a little bit more efficient. So I guess like my argument with RWA and how I assess things is like the underlying asset that people wanted in the first place. So.
Yeah, and I think also, and again, whenever we've taken a deeper dive into one of those like tokenization, we have to admit a lot of it's money laundering. A lot of it's, so there is a lot of the usability of these tokens, is money laundering, it's criminal activity, it's semi-legitimate activity. So it's hard to build big companies when that's your underlying asset, your underlying market, let's say, is that. It's going to be hard to build.
That's one world of assets, and that's not the world I play with as well. All the kind of Web3, NFTs, you know, let's put that world aside. That's a different conference on the other side of the country, right? So in this conference, I think that a lot of governments actually launch their own digital exchanges. So I'm from Malaysia, and so so we've got a digital exchange. Singapore's got a digital exchange, and they're asking fund managers, including myself, say, hey, do you want to list your fund or secondaries of your fund on the digital exchange, and you can tokenize this and do that? I'm like, well, I don't know. Do you have LPs for me?
But
if you got investors for me, like maybe I'll put it on your platform. But again, underlying is like this asset tradable. Like, is there like a supply demand that matches?
You're not gonna trade your asset. You're not gonna trade your fund on an exchange.
No,
right?
I'm not. Absolutely.
You're not gonna do it in exchange because of transparency. You're not gonna do it because of regulation. You're not gonna do it because it really has no value over being private. And that's the problem with all those digital exchanges. Nobody's been able to yet create something that really shows you value over a traditional exchange.
But I'll give you one example though that is mind-blowing to me, okay? So my wealth banker contacted, WhatsApp my wife, okay? WhatsApp my wife, and she says, hey, look at this.
I don't know if that's a good sign.
Yeah, I don't know if it's a good sign. Tells my wife, said, hey, look, there's this unicorn fund that you can now back.
500 Global.
No. It's some other person's fund, right?
Target.
And that's when she texts me, she's like, what the heck, what's my wealth manager WhatsApping me like a unicorn fund, right? Then I get the materials, I look at it, and it's a friend I know from Singapore. And he's got secondaries of Airbnb and blah, 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 and before they went public, you know what I mean? It's just these kind of PIPO things, okay? So, but what is it doing being distributed through like a private wealth bank, right? So I subscribe to it because I want to read the documents. So suddenly I've got a stack of documents, and I saw that they use unit trust. The fund manager uses unit trust mechanism to actually park some of these illiquid pre-IPO assets in there, and managed to, cheat code it through the private wealth distribution to very, very quickly raise a few $100 million. So I'm like, that's genius. So you see, the supply demand of that distribution, it creates a reason for you to actually want to do it. Now, is 500 doing it? We're like, well, we have to find the right conditions for that to be good. But all I'm saying is that I'm bearish on RWA, to your question, if the underlying asset supply demand doesn't make sense. But if there's case for it to work, I'm always looking out for these exceptions because I make money from exceptions. So I'm always looking for it.
I'm curious about, so we talked about solutions, and maybe bringing the discussion back to the AI subject. Are we seeing business model changes and adoption on a AI perspective that's enabling a lot more sort of, opportunities? Are we seeing a lot of interesting sort of sectors that are adopting it a lot more within their business models? I'm just curious about your views within the business model shaping.
We're seeing a lot in the service, sort of customer support, customer success, sort of that type of world. But I think in every end, not to be like trying not to be repetitive, but I think it's an important point. In every wave of innovation, the first models were the least successful. The initial sort of, if you think about companies that were 2008, 2009, when this cycle, 2009 when cycle started, companies that were super, revenue generating, Groupon. All these models were marginal models. They were short-term good, long-term bad. That's, I think, also something that we're seeing happening now. I think a lot of the models that are successful, app building, stuff like that, short-term, they're very good, they're very easy, very liquid, very easy to understand. Long-term, I don't think that's where it's going to be. I don't think I think we're yet to understand how generative AI is going to impact our lives. I think we're yet to understand what's the right investment thesis in generative AI. That's at least our sort of perception in the application world, right? In the application world, in the business model sense. What's the new SaaS? I've no idea.
Okay. Well, I think the point about novelty, like I have a thesis of investing called life after novelty. Because what novelty and gimmicks like Groupon does for you is that it decreases your customer acquisition cost dramatically. So I built a Groupon site in Malaysia many years ago, and I sold it to Groupon in 4 months. So I made a few million US dollars with 4 months of work, right? So I lucked out. I was 28 years old. Okay, I saw that. But what I learned from that lesson was after selling my Groupon company into Groupon, I saw that the smarter Groupon entrepreneurs, like the one in Korea, there's another one, is they use the fact that they use this gimmick of group buying to get so many customers, and then they launched real e-commerce. Yeah. And from that, they created Coupang in Korea. Now, Coupang is a massive success story, but it began with a gimmick, and they had life after novelty. So when the Web3 wave came, everyone was getting all these funding and customers, all because of novelty. And I was like, hey, what's life after novelty for you? Nobody had any answers for that. I'm like, nope, not going to invest. So I think the life after novelty concept for me, I feel is cheap land grab customer acquisition, which is why my thesis of investing in application layer right now is that whoever can very quickly grab a couple 100 million users and start charging them, I said, you better build life after novelty. You better see what's going to keep them staying, because if they're going to start churning, you got to talk to every churn customer and ask why. Like, did they just join to play? Or, you know what I mean? So I think that this life after novelty thing is one. Now, the second thing about my thesis and my biggest lessons with the money I did not make from investing over the past 12 years, and also my entrepreneur career, is that I had this subconscious conditioning that being an investor is like it's like a value investing game. I was like this micro private investing version of Warren Buffett. But there's a different world. In public markets, you have momentum traders. You got people who play on momentum. So as a seed investor, when you're backing some companies at 1 or 2 million money post valuation, and the Series A is at 8 or 9, or sometimes 20 or 25, why am I not selling? Why didn't I sell? I ran the math back on all these companies that I had a chance to sell because the late stage investors saw that, wow, this company is category leader. I'm just going to buy out all the seed investors. I said, no. What if I said yes? And the DPI, the IRRs, it makes so much more sense.
That's the real Warren Buffett. I made a lot of money selling early, right?
Yeah.
But look, although, just have to say, right, we've always been shitty momentum investors, right? We're very bad at riding the trend. We've always been, I think, better sort of fundamental investors. I think long term, right, because we're in such a power law game, long term, and this is true for it's again true for the AI revolution, we can have 1 or 2 or 3 outcomes in every good portfolio that are going to make a huge difference, and then all the selling along the way is not going to be good for you, right?
I'll expand that conversation a little bit, because number one, you don't have to sell all. Number two is you can choose when to sell. But more importantly is when can you exit. So, and I'm calling it in my context because you come in later, so I think that window is shorter. But I'll give you an example of one of my big unicorns. If I sold at Series C, that would have been like 8 years ago, right? But they went public, and then the price goes up and down and stayed down, and it's cheaper than Series C right now. So by the time I liquidated 8 years later, it was like a Series C minus price. So on balance, I should really have done it, right? So because the good thing is that at 500, we've done 3,000 investments in 80 countries. And we have all of the data. I've piped all of the data automatically, every email, every customer, every founder who sends their quarterly update, all of that crawls into our data lake. We have an API, and all my investment team has the API to actually play and build apps with Cursor to actually look at this data. And so I run all of that data, and I say, you know what? If we simulate this, if we simulate this, we simulate this, and we're trying to learn the lessons and not repeat it. So I think that I'm not saying I'm a full momentum investor, because to what you say is true. There are some cases that you do want to be a fundamental value investor, and it's very difficult to make those judgments when you have no sense of the adoption curves and you have no sense on the price curves. So I think it's going to hit margin and make these companies not profitable forever.
Seeing as we have just over a minute left, I'm curious about, so we've looked at opportunity windows, but I'm looking at, and we talked about liquidation, liquidity events. I'm just curious about, where is this heading in terms of liquidity events? Where are we finding them? I mean, is the driver, what you alluded to, is where there's a centralization of the Googles, the big players in the marketplace, you're owning the infrastructure, or owning the distribution model, capabilities, or is it, where is it coming from? And just wanted to end on that note, is where's the liquidity coming from?
The liquidity?
Yeah.
I mean, right now it's not coming from the stock market, unfortunately. And I think it's going to take a while until it does. I think we're going to see I think we are seeing, not we are going to, we are seeing a new model of companies, large companies staying private. I think that idea of we're going to stay private, for, SpaceX is going to be the sort of example for it. Let's see where Stripe goes. But I think a lot of these companies are saying, okay, we're going to stay private for longer. We're going to leverage the fact that there's a secondary market that's more active and that's more, open, and you can control pricing, right? Which is very appealing, I think, particularly from some founders. So we're going to see a lot more liquidity move to that secondary market. Although, by the way, so NVIDIA trades about 2.2 times a year, and SpaceX trades about 8% a year, right? That's if you want to so it's going to be hard. It's hard to create real liquidity in the secondary market, but still you can control pricing, and I think we're going to see more sort of move into there. And I think we're going to see a huge wave of M&A, because there's a lot of money on balance sheets of companies. They're going to have to buy AI innovation. They're going to have to buy these younger guys who are not in their structure. They're going to have to buy them in at mass. Sorry. We're going to have to buy them in at mass. So we're going to see a lot of M&A, and I think it's going to take time until we see the next IPO window.
And what's that mean as a seed investor?
Yeah, I look at it more internally. I look within to see is that if I wanted to engineer more liquidity sooner, what would I have to change? What are my base assumptions as an investor that I have to change? So I've come up with some reactions to that we're experimenting with. One of it is about preferred dividends. So if there's a way I can back a company and maybe I make X amount back first and then it kind of pairs down, these little innovations, it's not going to be, at least where it begins, it's not going to be the new mainstream. But when I look back at my investment career, when we first started with the KISS documents, as in reaction to YC safe documents, convertible notes was a complete new invention. And so I think that there are new financial instruments that could lend very well to the type of companies I have. But that aside, is that I'm also trying to monetize existing companies who are profitable, who have great revenues, but they may need to list on a local stock exchange. And I believe that if local stock exchanges don't become good, then we're going to continue this lopsided world where only the best companies list in the US, everybody else just stays around as some zombie. So I think there is more innovation that needs to be done within the VC industry. And number two, there's going to need to be more collaboration with local stock exchanges and also innovation with our LPs to say, look, how do we change the returns curve if we collaborate with different instruments, right? So I'm excited. I think we're using AI internally. I think we're looking within to see what we can do better as a venture firm so we can make more money for our investors. And I'm excited about what changes that might come with.
Thank you so much. Investing in the AI economy, the billion-dollar frontier. Please join me in thanking Khailee and Shmuel on their perspectives. Thank you.